Hello and welcome back to this short series on WAM Active. My name is Tomasina East. I'm in the investor relations team here at Wilson Asset Management, and I am again joined by Shaun Weick, who is the portfolio manager of WAM Active. Thank you for joining me again, Shaun. So in this episode, we'll be talking a bit more about performance. So Shaun, how has WAM Active performed in the last financial year?
Yes, the fund's had a good year. It ended up 75.5% for the financial year. The 3-year numbers are sitting around about 40.8%, and the fund has done 14.4% since inception. So we're obviously pleased to deliver those level of returns for our investors.
Absolutely. And what has been the main kind of driving factor of that performance?
Yeah, past 12 months, resources have been a big contributor, and we've had high conviction positions within the rare earth space with the likes of Lindian Resources and Viridius, within the copper space with Solstice, and then also smaller positions like Cobre, etc. And then finally the gold space has done well for us over the past 12 months, as with high conviction positions, the likes of Forestania Resources.
Amazing. So there's obviously quite a scope of stocks there. How flexible is the investment mandate for WAM Active?
Yeah, the mandate's extremely flexible, which is good as a portfolio manager.
Yeah.
So it has the ability to invest across the entire spectrum in terms of market caps, the industry exposures, the level of liquidity of the positions, etc. And then also the ability to invest both long and short, so we can bet on share prices going up or down. The level of cash we can hold within the fund is unconstrained. So as of the latest figures, we could sell half the portfolio in about 7 days. So the flexibility within the mandates is really good.
Yeah, and so how would you kind of position the portfolio in different rate hiking or rate cutting cycles?
Yeah, so it's really important, we think, to sort of identify the macro regime that you're in and then try and construct the portfolio bottom up to, I guess, capitalise on where we see the opportunities. So, FY26 was very much characterised as, trying to pick the turning point back in October when the RBA effectively went from, delivering, or what was thought to be delivering 3 rate cuts, in calendar year 26 to what's looking like 2 to 3 rises. So that's obviously had a negative impact in terms of the small industrial space, which is where WAM Capital invests the primarily amount of time and capital. So for us it was really that picking that turning point was a real benefit. Obviously looking at the key themes driving markets, the 2 main ones are really around we think AI and then the broader build out of AI infrastructure, and then also just critical minerals and resources, and sort of the growing importance of Western supply chains and reducing the reliance on China.
Yeah, and so you've kind of touched on it there with AI being a factor in the portfolio. Have you got any particular stocks that have been beneficiaries of AI?
Yeah, so I mean, generally I'd say across the board, the funds really benefited from exposure towards both directly AI, but then also the picks and shovels approach, which in the Aussie market is the way that people have primarily tried to gain exposure. So we've had listed exposures like Southern Cross Holdings, Fortify AI, which provides an AI data plane effectively that's cleansing data and materially improving the performance of agentic AI, through to the likes of unlisted positions in Firmus. We've also, played, the broader contractor space. We've had, NRW, Southern Cross Electrical, etc. So, the exposure to the direct AI build out, has been quite high. And then, we think, the broader aspect to that is really, the resources and the materials that are required to deliver on this. So, that sort of feeds through into our views around copper. We traded lithium throughout the year in various stages, which, had some good periods of performance. That's sort of a general sense of where things are sitting.
And what does Firmus do as a company?
Yeah, so Firmus is basically a provider of core AI infrastructure. So think of it as a AI factory where they're effectively trying to produce the tokens at the lowest cost possible. So the tokenomics, as they're termed for Firmus, are among the best in the world globally. So we sort of think of it as like the BHP of AI factories, where they're the lowest on the cost curve globally, and as a result of that, we think over time, they're best placed to take advantage of I guess, the boom in particular in agentic AI, which is driving, exponential growth in token usage. So as it stands today, they've got facilities within Singapore, the recently announced Batam facility, and then obviously within Australia as well. The current pipeline is around 3.3 gigawatts. If you back solve sort of the economics that we think they're getting on, at least the first 1 gigawatt that's been locked down, you're looking at a company that could have, well in excess of, $100 billion in revenue, and over $20 billion in EBIT. So at the moment, we're holding Firmus based on the last valuation of $145 per share, which is, around about 4% of the fund. There is speculation, I suppose, within what's being termed the grey market, that the shares are trading almost double that already. So we're obviously really positive on the prospects for Firmus. They've announced, a really significant deal with NVIDIA in Batam recently, which is the second one of its kind globally. So we think Firmus is being viewed as a core piece of the infrastructure from NVIDIA as this build-out continues. So we think it's incredibly exciting. And, the key things that we're sort of looking for and watching there is really, how the rental rates on the different classes of GPUs continue to evolve and the usage of AI evolves over time. But at this stage, there's nothing to suggest to us that that's slowing down. In fact, it's accelerating.
Fantastic. And so how would you say across the portfolio, how would you say the allocations are kind of split as it stands at the moment?
Yeah, as it stands at the moment, the fund's still overweight resources. It's sitting around about 45%. The key areas we like within the resource space at the moment is the rare earths, copper, and we like the gold space, although we think within gold, short term, there's potentially a bit of choppiness, but over a 6 to 12 month view, we think the setup's really positive. Within the broader industrial space, we are still maintaining good exposure to, I suppose, the AI infrastructure build out, the likes of Southern Cross Electrical, and then within AI, the other AI beneficiaries that are providing technology into the space, which is the likes of an Echo IQ, which is providing AI diagnostics over echocardiograms. Atria, which is providing AI-based diagnostics over CT scans, and then the likes of a Fortify, which is effectively the simplest explanation is it's cleaning the data so that machines can run quicker and faster in the what's becoming the era of agentic AI. So still overweight those sectors. The consumer space we think still looks challenging in the near term. The government, we think, have sort of magnified the impact with the CGT and negative gearing changes. The negative wealth effects associated with falling house prices and the like, we think is going to weigh on the consumer in the short term. But looking for opportunities to add exposure there at some point over the next sort of 6 to 12 months.
Mentioned quite a few stocks. Our shareholders love a stock pick. What would you say would be your greatest conviction call at the moment?
One we really like at the moment is Lindian Resources, stock code's LIN. So it's a rare earths project based out of Malawi in Africa, which we believe is among the best globally and will be the next large-scale rare earths project into production across the world. We think there's really compelling opportunities for these guys to go from only a light rare earth to also a heavy rare earth product, go further downstream into different aspects to the point that that we think they'll be partnering to potentially produce magnets and the like. The world and the rate at which it's advancing in terms of robotics, aerospace and defence, they're the key sort of sectors that are using, these rare earth products. So, we think the demand environment's very strong, and we think the supply side's tight, and being the next global project, of large scale into production, we think it's really well positioned to strongly re-rate off the back of that.
Thank you very much for joining me today, Shaun, and thank you all for tuning in.